All right, welcome back everybody here on the main stage at the Impact Festival. Time now for our next innovation area, and you can read it over there. It's all about sustainable finance. So we're going to explore the role of finance, the role of banks, the role of impact investing to really see how our money can be used to do something good. Laura, so what's coming up next?
Yes, before we dive into the topics, it's super important to understand the basics of sustainable finance, but also understand the risks for the financial sector. And there is only one person I feel that's the best person we can talk to, and this is Professor Andreas Dombret. He was the former board member of Deutsche Bundesbank. He was a super advisor to the European Central Bank and is now advisor to international institutions. I'm excited to welcome you here and learn more, as I said, about the basics. Please join us on stage. And also the risks. Yeah.
Mit Musik oder ohne Musik? Ja, ohne Musik. Hello everybody, thanks for your interest in the topic. I'm glad to be here. As this is in Frankfurt, I was asked to open this session about sustainable finance, and so I'll speak about the financial sector, what I think is important if you look at the financial sector and at sustainable finance. So let me start out with a question, and anybody can show the hand who knows the answer to my question. My question is, do you know what an oxymoron is? Okay, there are more hands than I would have thought. So according to Oxford Dictionary, it is a figure of speech in which apparently contradictory terms appear in conjunction. Examples for this would be an impossible solution, an open secret, old news, something like that. That's what I'm talking about. So not too long ago, many people would have added another example to that list, which is green finance. Open secret, old news, impossible solution. And I believe that today, if people think about green finance, they wouldn't say this anymore. Green finance is on everybody's minds, and no one would call it an oxymoron or a paradox anymore. And I'd like to explain why I think so. And I think there's good reason why this is the case. Greenhouse gas emissions, this is my firm belief, are arguably the single biggest negative externality of our time. Scientific consensus holds that emissions are excessive and that concentration levels in the atmosphere lie above what our ecosystem can absorb. And the result, as we all know, is climate change. So it's not new to us that climate change affects each and everything. It affects our standard of living. It affects migration flows, technological developments, the economy, of course. But the discussion about how it affects the financial sector, interestingly, is rather new, and not many people have been really thinking about that. A key term in the discussion, yet one which is not always used in the same way, is green finance. And I was asked to speak to you about green finance or sustainable finance. Many aspects are discussed under this umbrella. In the narrower sense, green finance is about how the financial sector can, broadly speaking, contribute to mitigating the effects of climate change and to promoting environmentally sustainable developments. For example, this can be done by steering funds and investments towards green technologies. And there is a second aspect in the discussion about green finance, and that is sometimes part of this debate, and these are the risks that climate change might bring for the financial sector. And as the introducer said, it's really the question of how financial institutions need to adapt if they are not to fall prey of these risks. And I will take the risk perspective in my little speech to you today. So this is the second aspect I'll be focusing on today. So the question I am asking you is this, and I'm asking myself: are we actually underestimating the financial risks associated with climate change? Are we underestimating the risk to a green or to a greener economy? And my answer actually, and I'll tell you already now, will be we certainly do underestimate the risks. The risks are much higher than we believe, and we cannot calculate those risks. I'll say a little bit more about that, so I will not only say this one sentence. So how does climate change potentially affect the financial sector? Once you start looking at this question, you realize that there are plenty of possible effects. But the most important ones that I see and that most scientists see can be categorized in two main channels. The first channel is the most direct one and involves all physical risks related to extreme weather events or changing climate conditions. So the physical risks is the first category I'd like to talk about. And this, by the way, includes floods and heavy storms, and they can actually cause severe damage to physical assets, by the way, both to private and to public assets. Other events, such as droughts or other more permanent regional changes in the climate, can have a actually devastating impact on crop yields and can impair the productivity of the agricultural sector and related industries. Clearly, in those cases, extreme weather events or changing climate conditions can result in significant losses for both the public and the private sector. And the financial sector, of course, is also exposed to those risks. If losses are insured, and that is one of my most important points, so if they are insured, the insurance sector is exposed. If losses are not insured, if losses are uninsured, banks and other financial institutions are exposed. For example, households are more likely to default on their loans and they are more likely to default on their mortgages, while the collateral they have provided to banks is no longer available to cover these losses. So credit risk for banks can also rise vis-à-vis corporates, not only vis-à-vis private customers. Those corporates who face a reduction in profitability, and to corporates who face a deterioration in their balance sheets. Wider economic repercussions, such as the disruption of local and global supply chains, we just witnessed that, and reduced productivity can and are very likely to cause significant additional costs and erode the value of investments held by financial institutions. Last but not least, an impact on economic activity will tend to worsen the fiscal situation of sovereigns, of the states, of the governments, and can ultimately drive up the sovereign default risk of those countries who take climate change lightly. Average weather-related losses per year worldwide have roughly tripled over the past 30 years, according to data gathered by my former colleagues of the Bank of England. At the same time, and that is worrisome, the share of uninsured losses has increased quite significantly. If, as expected, extreme climate events become more and more frequent and more costly, the future insurability of such risks will actually be called in question, I fear, and thereby this is widening the protection gap and is causing all sorts of issues. And I really think this is a significant development, as we have just seen risks that are not insurable are by definition always risks for financial stability. Banks and other financial institutions need to be very aware of this and need to be very careful, because there's no worse thing than risks to financial stability. Awareness of the potentially devastating effects of extreme climate events, and I mean not only for the economy but also for mankind and nature as a whole, has increased. And the global community actually has started taking action to mitigate the effects of climate change. As you know, in December of 2015, 200 countries finalized the Paris Climate Agreement, which then subsequently went into effect, and they agreed, and I quote, just to state this, to holding the increase in the global average temperature as well below 2% above pre-industrial levels, and to pursue efforts to limit the temperature increase to 1.5%, end of quote. Meeting this goal is very much of utmost importance and will require enormous efforts by all countries. And this is why the stance of the Trump administration in the United States towards the agreement was so worrisome, and this is why the stance of the new administration under President Biden is, of course, much better and much more welcome. Governments across the globe have voiced their strong commitment to honoring the ambitious climate agreement of Paris. If they succeed, this will, according to the best scientific evidence available, significantly reduce physical risks. So it's worth our effort to follow those goals of the Paris Accord. But it also gives rise to yet another kind of risk. I talked about physical risk up now. I'm talking about transition risks. And this is the second channel I'd like to look at. It should be taken as a fact that the 2-degree goal under the Paris Agreement can only be reached if economies across the world are transformed into green, low-carbon economies. Achieving this transition will require potentially disruptive technological advances as well as far-reaching changes in climate policy. And without a doubt, such a transition will prompt markets to reassess the value of a broad range of assets. Depending on how quickly and how orderly the transition and the associated repricing of these assets actually occur, they could become highly relevant for the stability of financial institutions as well, mainly of banks, but also of insurance companies. To illustrate one particular transition effect, let's look at the concept of the carbon budget, one of the most important effects and concepts I can think of. Now, meeting the target of the Paris Agreement will require limiting global carbon emissions. And to make a long story short, the Intergovernmental Panel on Climate Change estimates that in order to reach the 2-degree target, with a probability of only 50%, you still have a 50% of failing, but to reach it with a 50% degree of probability, the maximum amount of additional carbon emissions this century must be roughly below 1,100 gigatons of CO2. If you want to have a higher probability of success, of course, this would mean even lower carbon budgets. So let's start. So 1,100 gigatons of CO2 would give you a 50% of likelihood to reach the Paris Agreement. However, the total amount of carbon embedded in all known global fossil fuel reserves is estimated at about 2,800 gigatons, i.e. at a far higher percentage and number as I just mentioned. And this means that in order to reach the Paris Agreement and the 2-degree target with a reasonable high probability, about 2/3 of all known coal, oil and gas reserves must remain in the ground. And this has an effect, of course, on the financial sector. Because most companies who are involved in the exploration of these reserves are actually valued by the reserves in the ground. And they are making money by extracting them and refining them. According to the WWF, listed fossil fuel companies currently carry more than half of the total global fossil fuel reserves of their balance sheet. So a lot more than we could ever take out of the ground. So there will be a lot of assets which will become worthless. Those assets are actually called stranded assets. And if you have a company where your assets are worthless, this will have an effect not only on insurance companies, but it will have a direct effect on banks, as you would imagine. We have already seen some examples of sharp devaluations in the fossil fuel and energy sector because of this effect. One very often cited example are the top 4 US coal producers. They are listed at the stock exchange. And the combined market capitalization of the top 4 coal producers of the in the United States, they have decreased by 90% in value. If you look at German energy companies, you also see a huge decrease in value. So you can see that the assets you think you have, you may never be able to extract in order to fulfill the 2% target. So there are risks right there. And this is important to recognize that there are transition risks to go from today to a carbon-free environment. And this will not only hit the energy sector, it will hit the transportation sector, it will hit logistics, automotive, chemicals, and the heavy industry sectors. And there are going to be second and third round effects which are going to be very difficult to calculate, very complex, but they are there. And it's important to understand that these transition effects play a big role. And much like we discussed in the case of physical risks, lenders are exposed because of their reduced collateral values or the risk that their borrowers, once profitable business models, are no longer profitable anymore. Transition risk will be less severe the sooner the transition begins and the more predictable this transition is. It's a simple matter of fact that the longer one waits, the more one will have to act later on to meet one's targets. So it would be my wish that companies, banks, and corporates act as soon as possible and not wait too long, because it's going to be much more difficult later on. So we have identified two risk categories: physical risks that relate directly to climate change and transition risks that relate to society's response to it. So at the beginning of my little talk, I said, are we underestimating those risks? Yes, we are underestimating the risk. And I have no time left, but let me summarize. We are underestimating it because they are outside of our horizon. They are beyond the horizon of our horizon. So they don't look very careful. And equity analysts and credit analysts at the most look 5 years ahead. And by the way, they base all their studies on the past. And in this case, we won't get anywhere if we do look in the past, because we never had this issue before. So we have to look into the future. And there, the horizon, a projection horizon of 30 years, is not a credible one. This is why there are problems. So ladies and gentlemen, we are underestimating that risk, which worries me. So ladies and gentlemen, just like the CO2 levels in this room, we have to look at the CO levels in the atmosphere, and I would very quickly like to summarize. We have identified those two risk categories, physical risks and transition risks, and we have reached a basic understanding of how they work. And we now must, but we have no sufficient understanding how material these risks are. We understand there are risk categories, but we don't know how big they are, and whether financial institutions and markets are suitably taking them into account. I have mentioned a number of steps very briefly that I believe will bring us closer to this goal. Clearly, the work has only begun, and this conference is helping you. Let me end with a quote by French poet Victor Hugo, who once said, "You cannot resist an idea whose time has come." I think the time has come to do the right things also in the financial sector to help get to a low-carbon, emission-free future. Thank you for your time. Dankeschön.
Dankeschön. Thank you so much. I hope you are all aware of the possibilities now, but also aware about the risks. And this is also a good cliffhanger for our next panel and also expert, because this will be all about impact investing and measurements. And therefore, I'm welcoming Andreas Rickert. And previously, I looked up his LinkedIn, and I love what he had there, because he's the CEO of Fineo and the CEO of Nixdorf. And about Fineo, he said it's a think and do tank for strategic philanthropy and impact investing. So to me, that sounds really appealing, and I'm curious what you're gonna tell us in a few seconds. Thank you so much, and welcome on stage.
Yeah, thank you very much. Thank you very much for having me, for inviting me to the festival. And I want to talk about the impact age. So welcome to the impact age. So if there's one thing you might remember afterwards from all the things I'm going to tell you, is the times has changed and it's now all about impact. That's all you have to know. For the ones who might be interested in a little bit more details, I also have a few more details we can talk about. And so I will cover basically three things. So first of all, why? So why are we talking about impact? Why are we talking about purpose? Why do we care about a new age? Secondly, I will talk about the ecosystem. And for me, a great indicator that we are not talking about silos anymore when we talk about impact, but about really an ecosystem is this festival. So many people from different backgrounds are coming together to this impact festival. So we're talking about the ecosystem of impact. And thirdly, and that might be a little bit the boring part, we're also talking about how to do that. Because if we talk about impact, we also have to know how to measure it, how to manage it. But just to make that disclaimer right at the beginning, it's not about the methods, it's about the mindset. But nevertheless, it's sometimes also good to know how to do it. Okay, so these are the three parts we're going to talk about. So, even though I'm a very optimistic person, and I'm very energized being here with people, like-minded people like all of you, we have to start a little bit with the downer. So there are so many challenges out there. Plastic change, CO2, we just heard about that, migration, terrorism, war, inequality. So I can continue this list for on and so on. And that's quite frustrating. And it's all so nicely summarized in the SDGs and the Sustainable Development Goals. So that's on the one side. On the other side, and that's good news, we can tackle those issues. We don't have to be frustrated. So there are instruments, there are resources, there are ideas out there with which we can tackle those challenges. And for me, three parts are most relevant. And I start with the values. So the mindset is important, the attitude we're having. And secondly, of course, yes, we also need ideas. But we do not have to have innovation all over the times. Sometimes also things which come from the past might also work. So don't just say that innovation is the ultimate goal. So, but we need innovation, we need ideas. And thirdly, of course, we also need resources, we need financing for that. And I will also cover that part. But so these are the three ingredients we need when we would like to tackle, to solve the issues we are facing. And who is doing that? Who is having impact? And I'm saying everybody's aiming at impact. And this is maybe what really makes the new ecosystem, the new age we are facing. Everybody is looking for impact, and they might start with the individual level. I don't know, in my case at least, I'm surrounded by people, by individuals who are just talking about impact. Yes, it's a bubble, but I think still it's a good indicator of how the society is developing. So my daughters, I have 3 daughters, they're asking me when we're having dinner, what is changing in the world, how can we have a better world, and so on. So this is starting there. So we're talking about our colleagues, our customers, our clients, so the employees, all are asking what is the purpose and how can I achieve impact. So that's on the individual level. And then we see the different sectors. So we see, of course, civil society, the non-profits. I mean, the core reason why a non-profit organization is existing is they want to achieve impact. So this is definitely a sector which can claim for a good reason to be an impact driver. And it's huge. I mean, just to give you an idea, when we talk about the non-profit sector, I know here at the festival we are mainly talking about the social business sector and financing, but when we talk about the non-profit sector, we should be aware this is a huge sector. We're talking about roughly 600,000 non-profits alone in Germany. They're all aiming at impact. Worldwide, it's more than 10 million. They're all aiming at impact. So that's huge. Then the public sector. The public sector should be there. Politicians should be there to achieve impact. Sometimes they are distracted by other ideas, but mainly this is a key function of the public sector to achieve impact, to make the world a better place. And we do see that they're picking up our topics. And we are facing the elections here in Germany, and regardless which colors we are going to have, I'm pretty sure that our topics will have a boost afterwards. So they're working on the regulatory framework, but they're also spending money towards impact. And then there's a fourth part, and that's the private sector. The private sector, yes, is not an altruistic sector. So a company is not there to do good per se. But we see that also companies, startups, but also corporates are realizing that they should have impact. And this is, I think, quite astonishing because they are not just gaining and looking at greedily getting money, but they also would like to contribute. And this is coming either from their customers and their employees, but also from from the insight that by taking sustainability into the core of the strategy, they can even be more successful. So this is basically the entire ecosystem, so everybody is looking for impact. So what does it mean? It means not only it's good that we have all of them on the side of impact, we also need it. And here's just one number which is sometimes a little bit frustrating. I refer back to the SDGs. So if we would like to tackle the SDGs, we need this money. And there is still a gap. There is a gap of 2.5 trillion US dollars annually. And it becomes quite obvious that just public sector and governmental spending and non-profits and philanthropy, they cannot fill the gap. So we have to mobilize the capital markets to really work substantially towards impact. So this is why we need to work across all sectors to achieve impact. So that means we need all the different financing instruments, and this is, I'm pretty sure, a scheme you have seen before. So we have philanthropy on the one side, we have the traditional investment on the other side, and in between we have all the different categories how we can achieve impact with financial instruments. I don't want to walk you through all the different details, but important is that we have sustainable finance and impact investing in the center of it. Just as a definition, when we talk about responsible investment and sustainable finance, we mainly apply instruments like ESG, and that mainly means that we are trying to avoid harm, which is good, and honestly that should be the base. There should not be anything else. I mean, traditional investing where you harm the world should not be allowed anymore. At least it should be so expensive that it shouldn't be possible anymore. But responsible investment still is a minority. In Germany, we have roughly 5% of all assets under management which are ESG compliant. This has to grow, but definitely impact investing, which is turning the investment theory into positive, has to grow. So impact investing means you invest with the intention to achieve impact and to measure the impact. This is just a brief excursion because I've now mentioned two different things, ESG and impact investing / SDG investment. So these are interlinked. So you can see that you can basically map and combine the ESG criteria with the SDGs, and you see that they are correlating in many cases, but you can also see that there are gaps. So there are some aspects which are not really equally covered by ESG criteria. And that it means, on the contrary, that we also should focus on impact investing from a helicopter perspective. So we need to zoom out and look, so what are the gaps, what are interventions we even need more money for, and should focus on that. So this is just a quick excursion so that you know what is the combination between ESG and impact investing, which we do see in many different contexts. So, now digging into impact investing. Impact investing, the word is around maybe since 15 years, and it has for a long time been a quite small topic, a niche. Now it's coming out of the niche, it's becoming mainstream, and there are different drivers for that. Yes, the challenges I have mentioned at the beginning, but we can also see that impact investing is expanding in two different dimensions. So first of all, regarding the asset classes. Impact investing, and this is an important point, is not an asset class. Impact investing is an investment strategy, which means that you can basically apply impact investing to all different asset classes. And this is now happening. So it started at the beginning with investments mainly in private equity and venture capital, which is so easy because you have a small target, it's easy to capture the impact. But now it's going to all the different other investment classes. So for example, we have private equity, we have loans, we have real estate. I personally like also the idea of hedge funds. So I'm personally sitting on an advisory board of an impact investing hedge fund. So I see that we see also activism going into the field of impact investing. So this is regarding all the different asset classes. And complementary to that, we see that now other investor types are going into the field. So it started mainly with high net worth individuals and family offices doing investments into social businesses. And now it's moving to foundations. Honestly, I'm a little bit disappointed that foundations were not the first movers, but okay, they're always claiming to be quick, but usually they are not. But now it's going also in the field of institutional investors, which is important because we have to move the capital from the pension funds of the world. And of course, then we go into the retail market. We are not there yet, but there are also players out there, like, for example, Tomorrow Bank, really aiming at bringing impact investing also to the investors having smaller budgets. So this is how the impact investing ecosystem is growing along the different dimensions. It is really becoming mainstream. A little bit more details about what does impact investing mean. So you are just adding a third dimension to risk and return. The third dimension is impact. Yes, of course, all investments, even if you just do investments with two dimensions, have impact. But nevertheless, when you take impact investing seriously, that means that you very specifically focus on the third dimension and you are managing towards that. So this is what impact investing means. And even more simplistically, it means you have a situation, you have a problem, you plan an intervention, then you have an interaction, and then you are hopefully having impact, a positive impact. That's simple. The more complex thing is to measure impact is not that easy, not as easy as the two other dimensions. To measure the return is quite easy. To measure risk is also relatively easy. But if we really take it seriously with the three dimensions of impact investing, we also should know what the impact, what the third dimension is. And that's so complicated because there are so many different types of impact. So you can have positive impact, this is what you're aiming at, but you might also have negative impact. You can have, of course, the intended impact, but sometimes just by accident, you also have unintended impact. You have impact immediately or long term. You have impact with the beneficiaries directly or with the society. So this is something you have always to take into account. And so it's important to see that impact investing is not just about the management or the measurement, but more a holistic strategic approach. And here I have listed a few characteristics what means impact investing. Yes, of course, that's a no-brainer, as I've said, financial return alongside with the social return. But there are a few other things which are important. So first of all, it's a holistic approach. So holistic means that you are including it into your entire management cycle. It secondly means impact is essential, please measure it. Thirdly, it's based on values. And this is a tricky thing, because values always come with a normative mindset, with an idea how society should look like. So that's why we always say, whenever you start with impact investing, the first thing you should do is thinking about how do you envision the world? How should the society should look like? What is your idea of an ideal world? And then you can start doing your investments working towards that. So it's always combined with values, and this is also why you usually cannot just delegate your investment decisions towards an anonymous group, because it also should come from your heart, from your values. The fourth point is stakeholder orientation. I've already mentioned beneficiaries, so please try to understand whom you are affecting with your activities, with your interventions. Who is also in the ecosystem? Who are your stakeholders? And these are not just your investors, these are your partners, these are the beneficiaries, this is the society as a whole. And then the last point is, please think from a systems perspective. You might have a portfolio of different investments. And yes, your specific portfolio company might only target one intervention, one group. But as I've shown also with the interlinking of SDGs and ESG, try to zoom out, try to understand, so what are really the gaps, what are really the interventions, what are the levers, how can you have scaled impact? So this is what also should be engraved in impact investing, always aiming at a systems level, changing the system to a better. So these are the characteristics you should try to use when you are talking about impact investing. This is a very simple management cycle. I'm jumping over that, but again, impact investing is not just about measuring it. Yes, you should analyze what you are achieving, but it's also about really planning it and learning it. You can say it very nicely, to prove and to improve. So these are the two goals when you are analyzing your impact. This is a framework, and I'm not walking you through now all the details, But this is a framework which is quite important. When you set up your theory of change, you should use the IRR instrument. This is coming from development aid, and the key idea is that you start with the problem you want to solve, then you define the needs of the beneficiaries, then you develop your vision, your goals, and then you have inputs, your sources, networks, etc. And many people do stop there. When they're reporting about the impact, they stop with saying, I've invested X million, I've done 10 trainings. This is not impact. This is just basically your input and your output. The impact is, have you changed the life of people? Have you changed the world to a better? This is what impact means. And so please do not stop by just counting the people you have affected. Really say what you have changed. So this is an important framework taken from development aid. And this is my last, and this is the most heavy slide, my last slide regarding instruments. The key message here is impact investing is really becoming mainstream. Impact investing is using now instruments which are not tailor-made anymore, but we have an industry which is using standards, which is using databases, which is using KPIs we have all agreed on. So please do not do your tailor-made thing, but really refer to what is going on in the international world in the impact investing ecosystem. And these are a few frameworks. I would like just to mention the Impact Management Project. More than 1,000 organizations have agreed on this framework. So when we do impact investing, please use that one. It helps you a lot. And if we do all that, yes, impact investing will become mainstream. Nevertheless, we should be very carefully watching who is claiming to be an impact business or an impact investor, because sometimes we might also see fraud. Sometimes we might see people who are just claiming to do impact. I'm welcoming everybody who wants to try, but please be honest. So this is where we have to be careful. Nevertheless, I do see a huge chance that we are really entering into the impact ecosystem, that we're entering to the impact age, and I'm very much looking forward to doing that with all of you together. Welcome to Impact.
Thank you very much, Andreas. Your applause, and you were part of the impact age right now. And what I liked a lot was that you're pointing out the gaps that we have when it comes to financing all the many SDGs that we have. We're now doing a quick stage transformation, and then we're going to talk about the green transformation and the role of banks. And for this, it's my pleasure to introduce our panel moderator, Stefanie Pietsch. You are Managing Director at Commerzbank for Client Proposition Management and Wealth Management, and you're basically in charge of sustainability topics for small and medium-sized clients. So sustainability is at the core of what you do. Please come on stage. First of all, we're going to talk about the green transformation. This is your applause. And it says green transformation, banks as part of the solution. And I was wondering, is there a question mark and or an exclamation mark missing? Maybe something you will discuss today. So I'll hand over the stage to you and enjoy the panel.
Thank you so much. Hello, everyone. Good afternoon on this wonderful and exciting day. So, as just pointed out, I have the honor of hosting this panel, and of course I'm not by myself to find the question mark or to find the exclamation point at the end of this discussion. So please welcome with me on the stage Sebastian Stricker. Okay. Holger Schulte. And Matthias Kopp. So thank you so much for joining us. So we have 25 minutes to look exactly at the topic just pointed out. Let's see if the banks can be a solution of the green transformation. But before we do that, I would like to introduce you a little bit further. I'll start with you, Sebastian. So Dr. Sebastian Stricker, he's the CEO and founder of Share. I guess some of you have this in their hands, so you know what it's all about. Before that, he was the founder of an amazing app, Share a Meal, with 120 million impact meals shared and about 5 to 6 million users. So amazing. And before that, he did many things. He was part of BCG. He was helped the Clinton Trust and was also helping the World Food Organization to really make impact. So it's wonderful to have you on stage. And I think I can share this. He's actually nominated as the Man of the Year or Austrian of the Year. So everybody who wants to vote, I think that would be awesome. Then I'm really excited. I'm really excited that Matthias, you found your way to be with us today. He's actually the director of WWF Sustainable Finance. This he's been doing since 2005 with a great expertise. Before that, he has also been in the consultancy business, and he is a part of the Committee of Sustainable Finance for the German federal government. So a lot of expertise, and I'm very excited to hear your thoughts on the topic. And last but not least, we have Holger Schulte. He's from Commerzbank. He's actually in charge of transformation, sustainability, and also strategy. So I think topics that really belong together. And before that, he was in the risk as a risk officer. So he's got, I think, both important ways to look at the topic. And he also was in the consultancy business. So I think we all have the same background and all found your way into impact in some way, fast or not so fast. And I'd love to kick off the conversation with you by having a look at the topic itself. We all know that sustainability is multifaceted, it's super complex, and there's no real definition of sustainability. So to understand what are your thoughts, I would like to just hear one or two sentences of each one of you. What is your view on this topic? And I'll start off with Sebastian.
Okay. So maybe as some of you have been as well, I used to be a Boy Scout when I was very young. And it was a beautiful experience. But one thing that I remember was Baden-Powell, the founder of the Boy Scouts, or the Scouts in general, that said, try and leave the world a better place than you found it. That's not the typical definition of sustainability, but one that I can very much relate to. So my personal definition of sustainability is that I want to try to have a positive impact.
Mm-hmm. Okay, Holger, would you share your thoughts?
Of course. I think it's a good question to start with, because there's so many definitions and frameworks around sustainability, but they're all different. We have lots of them. There are so many metrics about sustainability, and everybody is starting to measure different. That's very important and a difficult issue. In Commerzbank, we try to approach the topic of sustainability on a very comprehensive and as well as holistic way. We want to affect the complete organization within Commerzbank. It's one of our cornerstones in our strategy, and we span it over two dimensions. The first dimension is the transformation. It's the bank transformation. We want to get to net zero with scope 1, 2, and 3. And this is focused on our own emissions. Second one is on our customers, the transformation. This is for a financial services industry. It's much more important to focus on the customers because it's much more than our own emissions. This is the first dimension. And when we talk those two to the second dimension, we talk about the ESG. So we had a kind of matrix when we define sustainability. And this ESG is, of course, generally speaking, same weighted, but the clear focus currently is on the E part, because everything here will be potentially irreversible. So we start with the focus on the environmental part. And the key driver of all is our commitment from Commerzbank to get a net zero bank. That's all behind.
Okay, so environmental climate focus.
Yep.
Perfect. Okay, what are your thoughts on sustainability, Matthias?
I have three thoughts and things that I brought with me. To me, sustainability is a process, it's an ambition, and it is about protecting what will otherwise be lost. So in one more sentence, making our ways of production, consumption, and for that matter also what we finance sustainable. So it's more a process rather than sustainable finance as such. It has, and this is borrowing what Andreas was saying in the previous presentation, it has to be related to a reference to an objective, to an ambition. So in line with science would be my take, because that's the best and the most objective as we have. And then it is about also in the immediate and short term, protecting what will be lost if we don't get the system adjusted and in place.
All right. Let's stay with what you're just saying now. In January 2000, the WWF gave out the first report. I only have a German. I'll try to translate in a second. Kurswechsel bei deutschen Banken. So changing the ways German banks work and think. And actually, you assessed 14 banks, 14 German banks, and had some key findings, and just on the degree of their sustainability. And now, 1 year further in, you guys went out again. You asked 15 banks, and the report has not been issued, but I think it's about to come out. Can you share some insights and some main findings you guys had this year?
Yeah, maybe also 3 things. I'm limiting myself to 3 inputs every time. So. Just a quick word of background, it's the 15, 14 largest banks in Germany by balance sheet and with a more or less complete business model. So no niche banks and no sort of more or less one-dimensional banks that we analyzed. And we, in the first year round, focused very much on climate. And this year we added biodiversity and ecosystem services quality performance in that assessment. And if you wanted to take a look at what this year outcome is going to be, compared to last year, what we see is an improvement. We see an improvement very much in sort of across the board, but mainly in how policies and strategies are formulated. So there's basically no bank anymore that isn't having a target. Most of the banks are to some degree aligning with 1.5 degrees and 2 degrees. So that's a positive. And then the second one would be if it then comes into making it more concrete and translating it into actual implementation, operationalization. What does it mean in terms of metrics? How does it relate into implementing in incentives with staff, etc.? That's where it still is a gap, and that's also where it's quite a distance in terms of the assessments where we're on the strategy side. And then when I now link in the component we did for the first time on biodiversity, that's pretty sobering, in the sense of basically no German bigger bank has a clear objective formulated on biodiversity and ecosystem services, nor has it been translated and implemented. And not stopping on a bashing side, that's not a surprise, because the regulation isn't there, the data isn't there, the customer isn't asking. That's also not an excuse, but it's to some degree an explanation, but that is 3 of the main sort of findings we found.
You were just saying on the bashing side, so yes, Sebastian?
Maybe can I jump in on this? Did you see any commonalities of the banks that are doing better than other banks? Is there anything, any traits that the good banks have?
Maybe to answer your question in that sense, one commonality is the banks that are most exposed, because they are larger and more public-facing, got a bit more heat, and hence there's more momentum. The more specific in some areas banks are, the less holistic the approach is, but then also the deeper the analysis and the sort of the response has been. But it's not a sort of a comprehensive way forward, I would say. What we have seen last year, and maybe also Georg in the very final presentation today will talk about it, is there was a voluntary commitment on aligning with 1.5 degrees by the German finance system last year, and I would think that gave a bit of a momentum on collaborative discussion and joint forces by finding solutions and not reinventing wheels everywhere, if that is a bit of an answer.
Well, you were just talking about bashing or criticism. I think regarding sustainability, it's always easy to criticize. I think it's always easy to find the thing that isn't perfect. From my point of view, and that's something we just heard before as well, it's all about the transparency and about being real. So maybe just to toss it to you, Sebastian, what is your point of when is something sustainable enough, and when is the perfect good enough to, or not perfect good enough to approach the market?
Yes, I think it's a very important question for organizations that claim that they want to be sustainable. I represent an organization that produces these bottles. Now, is such a bottle sustainable or not? It is made of plastic, but it is recycled plastic. How do you actually assess whether you are allowed to bring a product to the shelves if you claim that it is sustainable? And I think it's a very, very difficult question. There's multiple dimensions that you can look at if you claim to be sustainable. It can be ecological sustainability, it can be social sustainability, it can be economic sustainability. Now, and then there's an added difficulty that there's almost always something that you can improve on. There's some aspect that you can look at. We can look at the packaging, we can look at the climate footprint, we can look at the supply chain, salaries that are being paid in that supply chain. So it's a complex topic. And there's almost always something that you can criticize. Now, there are some approaches that you can take on this, and one approach that we are partly pursuing at Share, it's not free from criticism, but it's one that we sometimes think about, is a heuristic where we say, in our case, shelf space is limited. So if I go into a supermarket and I see different mineral water brands, I, as Share, if I bring my mineral water into that shelf, one other brand will need to be kicked out of that shelf. So the question is, if our product offering is more sustainable than the product that we're kicking out of shelves, do we already have a moral obligation to actually bring that product out? Because simply by launching that product, we have already made a positive contribution to the world. So that's one way on how you can approach this. It's a very simplistic heuristic. It's not where we stop, but it's a starting point on how you can think about it. The other question, obviously, is if we claim to be sustainable, we need to understand what consumers perceive as sustainable. So it isn't limited to this simple heuristic where we kick out less sustainable products, but we also have to understand, for a brand that is sustainable, acknowledging that there's always something that you can do better, we have to understand what consumers actually currently consider sustainable and make sure that we meet this minimum threshold.
Would you see that for the banks as well? Holger, maybe how would you say, would Commerzbank share the view?
Yes, I would definitely say it in that way. Our target is to support our clients on their way of their decarbonization. That is where impact lies for the bank perspective. And it's not about a green or a brown discussion. It's about a transition of a whole entire economy a decade long. Mm-hmm. It's not about gathering data or explaining the footprint. It's questioning the supply chain. It's about looking at the energy consumption and rephrasing the perhaps complete processing. When you look at the chemical industry, the complete production process needs to be established perhaps in a complete renewed way. And that is the main challenge we are facing. And this will be so costly, and that is, you need to prepare as a bank for that, and we need to prepare our clients for that. That is a huge challenge we are facing.
You want to give a comment?
I wanted to come in and support to some degree, but also to a little bit contradict what Sebastian was saying. To me, sustainability is about a process and a transition. So that's fully aligned with what you say. I think in some dimensions with climate, it's fairly clear what the umbrella is, which is 1.5 degrees. I mean, Andreas Dombret was alluding to the carbon budget, to the planetary boundaries. And within that, there's tons of studies, tons of scenario discussions, which can say it's this technology, it's that sector, it's that progress. It doesn't come down to the individual product to say, what do I kick out? But there's enough orientation. I'm not saying you didn't say this, but just to sort of be clear here, the transition that we are confronted with and that needs to be achieved and established is fairly well mapped out. Hence, it's also not necessarily about new technology, innovation, something. It's all about implementation, and mostly because it has to be system-wide and systemic. It's also low-tech. It's buildings, it's infrastructure, which is stuff and technology we know, and it's about implementation. So only to add that, maybe to that aspect.
I think just to add some flavor to this and also create some transparency on the challenges that we have, and I as a part of the Share team, on how to interpret the question of sustainability and what we need to do. I fully agree. I think we know relatively well what we need to do on climate change and often ecological sustainability. But Share aspires to be a sustainable brand. And it's not only climate that we need to think about, but there's 100 different topics that we can also think about. The Sustainable Development Goals, I believe, are another framework that we can look at. And the Sustainable Development Goals not only talk about climate change, but they also talk about inequality, welfare inequality, inequality in chances, gender inequality, poverty, food security, nutrition, and so on and so on. So it's, to be brutally honest, it's quite difficult for us to understand on which of those dimensions we can focus on, which other dimensions we not focus on so much. So I fully agree on climate change. If we were to only focus on climate change, I think it would be relatively clear what we need to do. But unfortunately, we aspire to be sustainable on all of these dimensions, plus economically sustainable.
Looking at the future, I'm pretty convinced that it's all about capital allocation. And when the taxonomy it's finished, and when the measuring of data is finished, we have set all the targets. Then capital allocation will have a different power, and then we will take care of which is in the supermarket and which is not in the supermarket. The client or the bank or whatever, which is not on the pathway to decarbonate the future, will be out of the business. That's for sure.
So if we look at banks as part of the solution, I find a lot of times it's about collaborating. Share some views of how can collaborations between banks, between other companies work that are maybe not state-of-the-art now, but will be the future. Who would like to maybe, Sebastian, for you?
Well, yes, we are engaged in such a process. We're looking at the banking sector. We're speaking with a lot of banks on this. So I think for you to maybe understand our thinking a little bit better, we are in a luxurious situation where we want to optimize for social impact. As a company, it's quite unusual. Typically, companies have to optimize for at least break even, making sure that you don't spend more money than you actually create in revenue. Right now, we're relatively well funded, and we have an agreement within the team that our number one key performance indicator is supposed to be social impact. And I would second what you're saying. Right now, we're in the FMCG space. So we're selling mineral water, we're selling candy bars, we're selling stationary products. I'm very proud of this. We're supporting educational projects. But if we want to approach the maybe an even bigger lever, then not only FMCG spending, but any spending, and hence financial solutions, hence payment, seems to be the way that we need to look at. And so we are actively looking at partnering with such a payment provider, so that we not only approach the spending on FMCG, but so on fast-moving consumer goods, which we currently do, but ideally add a sustainability layer to any payment that you do. And I think maybe coming back more concretely to your question, we are a relatively young organization. We're about 90 team members at the moment. Banks are typically much bigger, have a longer history, have their own bureaucracies that need to support the business model that they do. It's not terribly simple, I have to say. It's almost it's different cultures having to decide whether such a combination can work.
Matthias, hearing this, what are your thoughts?
Yeah, I mean, maybe two things. One thing, to build on what you said, Sebastian, I don't think there's a sustainability component to a payment. There's an issue of what's the sustainability question and performance of any payment. So it's not just an element, but with a finance flow, with a payment, with an investment, you do have an impact, one way or another. And hence, get that clear and get that transparent is one thing. But to your question on cooperation and collaboration, and only quickly to share a few acronyms maybe, I think that's the name of the game basically, because you see it between individual segments in the finance sector, between banks and asset owners and asset managers. There's net zero, this and that everywhere, where groups team together and try to find solutions. There's discussions between the supervisors and the central banks in the network for greening the financial system, which you wouldn't have thought of 4 or 5 years ago. And then there is a discussion between real economy, as you were saying, and the finance system. And that's also increasingly working. So this notion of co-development, if you want, and collaboration, I think it's essential given because it is complex and things are interlinked, but it is increasingly becoming the norm. I mean, maybe that's a bit far-fetched to say, but you see it a lot these days, to the degree that already we need to be careful to say it's not reinventing wheels everywhere, because there's so much commonality. I mean, climate is climate in the banking sector on the underlying scenario level. And the same is true for water and for oceans and for soil and for... So there's a little bit of a tendency to team in groups, but at least there is teaming. So to also second your point on cooperation and collaboration, because otherwise it's just totally ineffective.
Mm-hmm. Holger, would you share some more thoughts of how can Commerzbank or other banks contribute to not only the private sector of customers we just talked about, but also help companies transform and transition? And
as I said, to get impact, it's not about the absolute level of CO2, it's the reduction of the CO2. And this will afford a lot of investments. And that is where we have to be. We have to help our clients and not saying, okay, you are on a brown technology, we don't support you anymore. We have to help them to get to a better green production process or whatever. And this is necessary. And as well as the client, we had set up currently a new framework, and as well as the client is willing and showing, and you can see the pathway they plan, and they follow that pathway, we are able to support them. And that is our role. I think we lost our role in the financial crisis. Now we have the possibility to get it back.
Mm-hmm.
Can
go ahead.
Jump in on if you say you have to help your clients, does that relate to the... If you say that you have to help your clients,
yes.
Do you mainly speak about providing them with financing on sustainable projects, or what tool set do you have?
We start when I talked about data gathering and stuff like that. This is just a starting point. When you look at a lot of clients, they are far away from that starting point. So get them involved, help them with gathering data, set up models to help them to decarbonize, then establish knowledge in the industry-specific, sector-specific knowledge to help the clients to convert to a better business model. That is where we can dig in. And of course, it's about money.
Mm-hmm.
Yes. To some degree, as from my perspective, to some degree, it's also about a new product. It's about a sustainability-linked loan, for instance, or a sustainability-linked bond, which links the sustainability performance, the transition performance, to the financing conditions, or then even to the access to finance. So it's to maybe get a bit beyond. And one comment I would like to make is the emission reductions to state or climate, to me, is more an indicator of assessing a status quo, but the actual impact would be the transition in the system. So it's not necessarily the directly related carbon emissions that is what we are after.
Right.
It is about this system change, if you want. And then hence the indicator of carbon reduced or carbon saved or even prevented might not be definitely not the only one. It might not necessarily be the right one. It's about, in cement, have you invested in that technology, because that enables you down the line to reduce your emissions aligned with the pathway.
So actually, looking at the time budget, before we end this discussion, and I think we could just stay here the whole evening and keep talking, because there's so many aspects we should look at. Please do me a favor, for everyone sitting here, but also listening at home. Give me one sentence or one takeaway, piece of advice that people can just pick up and keep rolling when they're out of here. So Matthias, what would you like to give to everyone to consider when they leave the room or turn off their computer at home?
Maybe not only one sentence, but not too many. One thing is about scale. So sustainability is about scale and speed, and that is basically in contradiction to perfection. But we do need to get going, given the timelines we've got left, to enter into this inflection point of the curve. It doesn't need to be solved tomorrow, but we need to be moving that direction. And that is, again, about scale and about speed. And that does mean it's not always about high-tech and innovation in 15 years. It's about results tomorrow, the day after, the next 5 years, the next 7 years. That's one important point to me.
Thank you. Holger?
I think there's no time left. We have to act now, and this stands for all companies and for all private individuals.
Sebastian?
Well, I think my statement as part of such an event would be, I think you're interested in a wonderful topic area. I think for all of you who are considering entering that topic area, please do it. It's something that people are interested in. It's a trend that has been growing over the last couple of years, and almost any study projects that it will become more important in the future. So if this is the topic that interests you, it will become more important in the future, so it will become even more attractive. So the only thing that I can say, I would encourage you to follow that path, and it'll be fascinating and exciting for you, but it will also be very important for the world that we hopefully leave in a better place, as a better place than we found it ourselves.
Could I add one thing? For those of you who are entitled to vote, go and vote.
That's a good point. So, everyone, thank you so much for listening in. I think the question has not been answered if it's an exclamation point or a question mark, but you see there's a huge role, and I think the responsibility has been recognized. I think people are taking over the responsibility. Banks are on their way. We'll all be excited to see the report that's going to be coming out from WWF. And I wish you a wonderful afternoon. I say thank you very much to you three guys. Amazing. And have fun. Take care. Bye-bye.
Stephanie, thank you very much. Maybe we tweak the question for our next agenda item, new banks part of the solution. So we're now talking about banking for a better future. And it's my great pleasure to introduce Ines Nureldin. Ines, he's the founder and CEO of Tomorrow, and he's really changing the way how we all handle our money. In our opening address, we were talking about risks. So I'm taking a risk now, and I hope I'm not offending anybody who's working in the banking industry if I say that Ines is my favorite banker. Ines, come on stage. Have fun. Stage door.
Hello and good evening together. I have to say I'm really excited to be up here. I came this afternoon from Hamburg by train, and I didn't know whether I could actually really do that, not presenting on Zoom anymore, because this is my first event outside of Zoom. And it felt kind of weird, because when I heard it's the Impact Festival, when I think of festival, I think of Woodstock and stage diving and things like that. So I didn't really know exactly what to expect. So yeah, I'm here really excited to have you all. And yes, I would like to talk about three things with you in the next coming minutes. I wanted to talk with you about impact. That's why we're here for, right? We're at the Impact Festival. We all want to contribute, create some positive impact. So the three stories that I would like to talk about is my personal impact story, what got me to do what I'm doing today, the impact of money and banks. That's what we already have talked about in the last 2 hours. And then what zebras have to do with that whole topic and the impact zebras can have. So I'll start with myself. So my name is Ines. I'm one of the founders of Tomorrow. I'm 40 years old. I have 2 kids. And I'm very passionate about impact startups and kite surfing. So if you have any shared interest in that 2 things, you're welcome to have a chat later on. And next, I'm really going to talk about what got me here to the Impact Festival. So I started my first company right out of university and was really 2005-ish. And at that time, it was not that cool to be in a startup. And I thought it was really a must-have to wear a tie in a startup at the time, so you can really feel the whole, startup vogue was not on yet. So I set up a tech company focusing on B2B, so something completely different. So I was developing, together with my team, software for B2B companies to make global supply chains of food transparent. And I grew that company over a time of 10 years. We had a team of approximately 100 people. And at some point in time, I then really realized that, you know, as a founder, you always like to solve problems, right? That's what founders are really good at, solving problems. And I realized more and more that there are so many challenges and problems out there in the world, and I would really like to use my entrepreneurial energy to at least try and help contribute, solve these kind of problems. And after reflecting for some time on that, I decided really to quit in my own company, leave my own company, and again start fresh. And that's what got me actually then into the whole idea of banking. But I didn't have a clue about banking. I'm not a banker myself, right? And which really gets me to the next topic, like what has money in banking to do with the whole topic. And when I left my previous company, I was really thinking, what can I do with my own money? I wanted to invest money. I wanted to save money for myself and my family. I wanted to invest the money to make a better future for my children and for myself. And then at that time when I did that, all the ETFs were really on vogue. I'm sure you're all aware of the term ETFs, so those exchange traded funds. They were all over the place. And I thought, well, that might be a good idea to go in there, invest in there. But I was really, you know, into sustainability. So I tried and looked into those products. And when you know, at that time, definitely you really had to dig to find out what is actually in that fund, what companies are being invested in. And when I digged deeper and understood what's really inside, I really came to my mind that those kind of products that really invest in everything. So from weapons to coal-based energy to forced child labor, you name it, everything is in there. And even the products that are labeled as sustainable products, even if you look inside there I could find companies like BP, ExxonMobil, Nestle, Coca-Cola, and so on. And so for me, it was really the question, what has this to do actually with real impact? And that really got the idea started, say, hey, we need to do something about that. And I got together with two friends of mine, and we spun off that initial idea. So when we look at the finance industry, and I think you heard it already in the previous discussions, I mean, we all committed at the Paris Climate Summit that we're going to stick to, you know, the 1.5 degree goal, way below 2 degrees. And even so, we agreed on that in 2016, the amount of money that is being invested by banks into fossil fuels has been increasing the last couple of years. So this is absurd, right? And we are all aware that we have great scientists out there who tell us every day that we have a limited time frame. Time is ticking. You can even go on certain website and you can look at that counter. You just have to be careful that you tick the 1.5 scenario and not the 2 degree scenario. Otherwise, you might think we have more time. So we have a little bit less than 8 years' time, right? And time is ticking, meaning we really, really, really need to act. And what does this actually mean? Yeah, I think there's a lot of data out there. We all know that the world emits at the moment 42 gigatons of CO2. So what does it mean? That our 42 billion tons of CO2. That's the whole emission the world emits every year. And our challenge is basically in the next 8 years to bring those 42 billion tons of CO2 basically to zero, right? So it's very clear. We have very clear indicators. We all have to work, and we have to measure ourselves against that. And so what does that have to do, again, basically, with money, banks, and funds. So the most loved investment product out there is the so-called MSCI World ETF or index, that invests in a lot of companies worldwide. And if we just take that one as an example, for every 10,000 euros that are being invested in that financial product, 1.5 tons CO2 per year are financed or invested in companies that produce that kind of CO2 per those 10,000 euros. And if you think about the scale, there are really thousands of billions of euros out there that are being invested in these kind of funds. And if you translate it into CO2, you have an impact of several gigatons, that let's say these funds are being responsible of or have influence on. And this really shows that the responsibility and the power that actually the financial industry has in order to change that. And that's why it's a critical part in the whole equation, and they can do something about it. They have the power to change the agenda here. So that's why it's really, really important that we actually put our money where our mind is, because we know these things, we have the facts, and let's do that. So there are many banks out there, I think including ourselves. We have Georg from Triodos here today, that have very elaborated processes of how you can screen in investments. And we shouldn't be fooled, out there by simple criteria such as ESG, where the world says, hey, there's environmental, social, and governance screening, and when those funds are screened, they're all good. This is not enough. We need to go to several steps of screening, and one very, very important step of screening is that we check our investment against the 2-degree or 1.5-degree goal. That's, for example, what we do, what increasingly banks do, and only then do they invest. And I think that is really, really important that this is increasingly happening now. And what's very interesting, also apart from that we can align to the 1.5-degree goals and make sure that the investments are aligned with the Paris Agreement, that typically those investments outperform traditional investments. So they have a better performance. And we also have our friends from Right Based on Science involved here in some of the panels and speaking slots. And it really, they're one of the players that help to calculate that and make it easier for the financial industry to invest in the really climate-aligned projects and companies. So, me and my friends, we decided to create a so-called fintech. So it's a financial technology company, because we believe that if you want to save the world, you actually need to throw a better party than those destroying it, right? So we need to make it really easy and convenient for people to come on board and make it easy for people to invest in the right direction or to deposit money in an easy way. And that's basically what we've done with Tomorrow. We tried to make it with a digital brand, with an app that's really easy to use, to create mobile banking for a better future by having basically an easy-to-use app where you can open an account within a few minutes, have a nice-looking card, and really try and attract people and get the whole topic of sustainable finance out of its niche where it stands today and bring it to the middle of society. Of course, we're still very, very young. Nevertheless, we try to track ourselves against the targets that we set. So at the moment, we're able to save approximately 2 tons of CO2 per user per year. We're trying to double, triple that in the next couple of years. But the most important thing, whenever you also found your impact business or you run your business, that you track your KPIs against those CO2 numbers and really challenge the impact that you're creating and think about of how we can scale this kind of impact. So what is different between, let's say, a fintech and a traditional bank? I think we try to create impact by using the customer deposits. Every euro that sits on a bank account, invest that sustainably as much as we can, offer saving and investing opportunities. What we do extra is that we have with every swipe that you do with a card, we use a so-called interchange fee to make climate donations that help us, for example, protect forests and leave CO2 in the soil. In another area, I think where there's huge opportunity also for banks in the future is to engage in a sustainable lifestyle. That means, for example, showing people in real time when you pay with your card, hey, I just bought a coffee around the corner. What's the CO2 footprint of that specific transaction that I just made? To give people some guidance, what is the impact that I have actually with every purchase, and therefore help people maybe to change their behavior, look at the CO2 footprint they are doing, because we all need to improve our footprints. What you're not able to then reduce, there's always the option then, of course, to offset, but this is the last resort. We also offer that. What does the whole topic have to do with zebras? So the world loves startups, right? And there are certain role models that we all have in mind when we think about startups, right? A lot of people think of Jeff Bezos, others think of Steve Jobs, etc., Mark Zuckerberg. And I'm the big belief that we need to forget about the narrative of so-called unicorns. Yeah, you all heard them, right? So unicorns are those artificial animals, and basically they're a symbol for a startup that has made it from zero to a valuation of $1 billion in valuation. That's it. That's the only criteria. And we have seen quite many of these kind of zebras in the last couple of years evolved, and we have never ever had that many zebras like we that many unicorns like we had today. And basically their narrative is move fast and break things, right? So it's even a quote by Mark Zuckerberg, and we know exactly where it got him to. And there are other companies, yeah? But if we look at the challenge where we stand, we believe that we need some kind of new role models that embody, solving real problems that we stand before. And that's why we believe we need zebras instead of unicorns, because zebras are real. They are black and white. They stand for profitability and positive impact. They're enduring, they're not short-term exit-oriented, they're untamable, so once they're headed for their vision, they go and execute, even if it takes many, many years. And they're untamable, so you can't ride on them actually, so you can't just take them off track. And they're herd animals, so it means they're community-based, they like to collaborate, and I know that my next speaker is also going to talk about collaboration, how we can do more together. And there are quite a lot of zebras already out there. Many of them are here. Some we had already here on the stage. So I think I would call everyone up. Let's go out there. Let's create more zebras. Let's work together on this very, very big challenge. We don't have time. Let's do it now. And I can also close maybe with the words of our previous speaker. We have an opportunity to go out and vote for the right future for all of us. Thank you.
So whoever car it is, please leave the room. Otherwise it can be expensive. Yeah, also a good cliffhanger. We still talk about money. We still talk about a sustainable finance system, or what impact money can also have if you're an early stage phase of your startup and you need money. And there are people who really can give you money and also know about their responsibility, what it means to invest in your company. And therefore, I would like to introduce our next expert panel, moderated by Peter Fricke. He is head of Deutsche Börse Venture. And I'm welcoming you all on stage.
Thank you very much.
The stage is yours.
Yeah, a very warm welcome also from my end. As announced, my name is Peter Fricke. At Deutsche Börse, I'm responsible for the pre-IPO and going public activities. And it's my very pleasure to have such a renowned panel with a lot of experts. So with data from the Global Sustainable Investor Alliance, the inflow into impact funds have actually risen quite a lot from 2018 to 2020, with now more than 35 billion being invested in impact funds. At the same time, we've been facing with the sustainable financial disclosure requirements since March this year, requiring a lot of investors to put a much more emphasis on their reporting standards when it comes to sustainable and ESG elements. And last but not least, of course, we are all striving still to reach the 2030 UN Sustainable Development Goals, but also the 2015 Paris Agreement on climate change. So therefore, I think it's a very good point in time to ask the question, what's the responsibility of early stage capital for sustainability? And this can actually be seen under different perspectives. On one hand, it's a way to pave the future for future investments. It's also raising awareness within the company for sustainable processes. And last but not least, it's also driving innovation towards more sustainable related business models. So maybe starting with you, Félix, what's your view? And also, how do you and your country are contributing to achieve this?
Thank you. I will give you some insight on how we see sustainability at Alter Equity. We are a French-based impact fund investing in Europe. So for us, sustainability is around 3 points. First, through the choice of the investment we do. We only invest in companies that have impact in core business, impact-driven purpose, core business. So it means we only invest in companies whose products or services contributes solving environmental and or social issues. So that's the first thing, the choice of the investment we do. Then having an impact through activity is good, but we think it's not enough. So we help the entrepreneur to implement ESG policies with a toolkit that we developed through an action plan of 15 criteria that they co-create with us at the time we invest in. And third, as an active shareholder, I think it's our role to challenge the entrepreneur with the same intensity on business and financial subjects as in impact subject. So it's through a board seat we are very frequently discussing this subject. So that's the way we see sustainability and our role as an early stage investor to promote sustainability. And we also think that proving that we can have a very efficient economic model and big impact can also show the interest to more skeptical investors that are not very impact driven but can be interested by the opportunity to invest for the economic reasons. So shortly, that's what we do.
Great, thank you very much. So Melisa, from your fund-of-fund perspective, how do you see this topic?
Yes, hello, my name is Melisa and I'm working for a European investment fund. I represent the LP perspective. European Investment Fund is the funding arm of the European Commission, the European Union. It has as its mission to support micro and small and medium-sized enterprises through investments in intermediaries. To this end, it develops and designs mandates with which it can invest. In 2012, the European Investment Fund raised a fund of funds specifically for impact investments. This is how we began in sustainability. It was a 250 million euro fund of funds. Today it is fully invested in 17 impact investing funds across the EU and the UK. Following this, in 2016, we raised some 200 million euro from the European Commission under a mandate that was called the European Fund for Strategic Investments to also invest in not only impact but the environment. Following this, in 2017, a further 100 million for investments in impact investing funds in Italy. Today we continue to, actually we have a program now where we're raising a fund of funds to continue our investments in impact and climate notably. And this is how we are involved in sustainable finance.
Thank you. And then last but not least, Lisa.
Yeah, hi, I'm Lisa and I'm representing UVC Partners, so providing you the view of the financial investor today. So UVC Partners, we are an early stage VC fund, 200 million in size. We invest into B2B tech startups. So traditionally, like from our investment focus, we're not specifically focused on impact. We don't call ourselves impact investor, but we did feel like there's been a massive shift in the whole industry among financial VCs to lean more towards sustainability. And this is in two ways. So on the one hand, ESG is kind of like a must. So really like avoiding the risk. And I also feel like more and more financial investors are looking into like topics that actually create a positive impact. Because what we have noticed and realized is that the misconception that we used to have in the past, many like investors thought that there's a trade-off between financial profits and impact. But this has shifted tremendously. Like new markets are opening because there are many like global problems that we need to solve, and this becomes super attractive to also generate financial returns. And also people want to invest into more meaningful topics. That's why for us it's very important. But I would say like it's really important because we see ourselves as like a great lever with the capital that we provide to invest into good topics that are actually tackling real problems.
Thank you. So Félix, you mentioned, of course, an impact fund, that ESG and impact sustainable investing is quite on top of your agenda. Let's say looking in your portfolio, at your portfolio companies, what are the most common challenges you're observing when implementing ESG criteria, and how do you help them to tackle these challenges?
Yeah, I will say lack of time and lack of tools. So we help them by giving them what I explained, these key tools. We have a list of 100 ESG criteria that you can implement in a small growing companies. And we co-define, when we invest in a company, we co-define with the entrepreneur their plan. So they pick 15 criteria, and then we have board during the year where we monitor the objectives, and then we can also add more objectives and help them to progress on their subject. So I would say tool and time support.
Very good. And you, from a fund-of-fund perspective, you almost have an even more corrective instrument, or at least techniques. So how do you apply those and more or less steer also ESG criteria for your fund-of-fund investments?
This is a challenge, which is made even worse by the lack of transparency in the market and also lack of understanding of what is ESG or what is impact. The two are not the same. And there's also confusion because there's a lot of greenwashing. That is one difficulty that we see in the market that's maybe making the market difficult to access for investors. But another one is the lack of a commonly agreed upon metrics for measuring impact. Until we communicate more on how to measure impact, and this is both at the company level and at the fund level, and then to us as the LP, when that improves, there will also be many more investors in the space.
Understood. And did you implement any own criteria, because let's say the official ones are not substantial or sufficient enough?
EIF is using its own metrics for impact measurement. It's where we ask the fund manager to set, together with the portfolio companies in which it invests, to set indicators based on the objective of each portfolio company. And then to measure the progress of the portfolio company along the way towards achieving its impact objective. And that way, what we begin to compare is not necessarily the impact objective of the company, but its path to getting there. Say it's 50% reached its objective, then we put a multiple on that of 0.5, and we give that to the company. That's weighted by the investment amount, so that ultimately the fund manager can have a weighted impact multiple, and we ourselves weight our investment in the fund manager to also get a weighted impact multiple. So starts with the portfolio company though, and all the work is done at the level of the portfolio company.
Good, understood. So Lisa, from your opinion, are there enough regulatory, let's say, requirements in place to really drive sustainable investments within the early stage, or do you see too much regulatory burden? What's your view on that?
So there's definitely like a lot happening on the regulatory side. Like with the SFDR, for example, I think when this happened, everybody was like, oh, we need to publish something on our websites and we don't know what, so we call our lawyers and the lawyers kind of give us a text. But I think it's good to like initiate the like thinking about this topic. But on the other hand, like SFDR and also like what you need to report under it, like I think there's still no taxonomy, no framework. Everybody's kind of waiting for it. And nobody like really knows what to expect. So it's definitely more helpful because like what's kind of happening now is that everybody's developing their own frameworks, developing their own like ESG questionnaires, but nobody knows like what's going to happen yet. And what would be helpful is if like from the regulatory side they really tell you, hey, okay, for early stage startups you should at least track this and this and this KPI and have this reported, because then we don't need to like spend so much time on like running into different directions. But it's actually like really good what's happening now. Like for example, there's a WhatsApp group and like initiative of maybe over 100 VCs coming together and aggregating the information. And I think this will also help set the regulations. But I think what's really important, like when regulations or like a more clear taxonomy comes, is that it doesn't swamp the startups, because oftentimes what happens is that VC or like early stage investing gets put into the same bucket with PE, which is addressing like way larger companies which have the resources and information to disclose. And if we put like that PE regulatory framework onto startups, it's just going to destroy them. So I think we need to be careful that we differentiate here.
Cool. Melisa, you have very good relations, of course, also the EU policymakers and so on, also with, I think, one of the major LPs is also European Investment Bank. What's on the horizon still when it comes to regulation or further, let's say, corrective measures in that sense?
I can't say much about regulation, though I know a taxonomy is being developed by the EU at the moment. The EIB and the EIF see environment, sustainability, climate, impact as strategic areas going forward. So of course we'll implement whatever the EU is giving us to implement as light as possible in as practical a way as possible on our VC funds. I hope that a clarity will bring more investors to the space. As I said, more transparency, more communication, more clarity will certainly help the market grow.
So, of course, political regulatory measures are only one side of the medal, but of course the demands from institutional investors, LPs, are equally important. So, Félix, do you see that this has changed over time, that they put more emphasis on sustainability matters? And yeah, to which degree has it changed, and what's the current status here?
Yes, there is a huge change, I think. We were discussing with Melisa just before the panel, but 9 years ago when we raised our first fund, it was a fund of 40 million, and we took 5 years to raise it. And our last fund, which is 2.5 times bigger, that we raised 2 years ago, we raised it in 18 months. So the demand is growing. We were like 10 years ago, we were like 4 funds in France. Today, maybe there is like 10 or 15 funds on early stage impact fund. So the demand is growing, and it's a good news. It's a good news. I think that the LPs are does really want to invest in the environmental matters and issues, maybe less in the social and societal. So maybe it could be grow faster on this issue.
And can you say whether they have any specific, for example, according to the UN Sustainability Goals, particular focus topics at the moment, or is it really across the board, or do you see some trends emerging?
All the subjects related to carbon are the main priority, I think, today.
Do you agree? Or do you have a different perspective?
Yes,
we see everything across the board.
Okay.
Of course, the energy market needs to undergo a transition now, ever more important. But we see education, health and wellness, I mean, everything across the board. There's a huge paradigm shift occurring in the market now, and it's beyond the SDGs and ESG and any unit of measurement. It's coming from entrepreneurs, it's coming from the GPs, it's coming from the LPs. The entrepreneurs are getting younger and younger, and for millennials and Generation Z entrepreneurs, doing business ethically and sustainably is a given. It's an absolute. And so there's that happening, and then GPs that are beginning to recognize the opportunity in that, and that they actually don't need to make the choice between a financial return and having an impact or having a benefit to the community. And there are LPs that are pressured potentially by this ESG questionnaires and the regulations, but also LPs like EIF that are able to get more and more resources to invest in the market. So there's a change happening, irrespective of really the UN SDGs. It's a natural paradigm shift.
Yeah, it's actually quite interesting what you're saying. like not only on the LP level, like definitely on the LP level, there's been like a huge shift, but this pressure that we as investors are facing is coming from all directions, as you said. So both internally, like when hiring new people, like young, talented people, and there are more and more VCs popping up, so they're all like fighting for the best talents. Of course, the best talents only want to work for a firm, like for a VC fund that is like sustainable or like good with ESG like itself. But also when investing, like I can feel this now, especially with like younger entrepreneurs, that they really care that the investor, even if it's a financial investor, that they're doing something in this field. So actually, one of the companies we just invested in, they have a female founder, and like in the first call where she met us, she was like, "Why do you only have one female founder in your portfolio so far? What are you doing in terms of ESG?" And like I really had to explain myself, like, "Oh yeah, we are working on it. We're doing so much. We're trying to diversify our deal flow, but it's really like something that you need to have nowadays in order to stay competitive."
Very good. And you already mentioned, Lisa, that you're getting some pressure from both ends, more or less, and you also put a very good example. So what kind of goals or ambitions do you still have as a fund with regards to sustainability topics, which you haven't reached yet, but would like to achieve maybe in the next 2 or 3 years?
Yeah, I think like we've already come quite a far, like long way. I think we started working on our ESG policy internally in 2019, which is when the topic just kind of got started. But I feel like we still have a really long way to go. Current, I would also say like standard is like these questionnaire, like ESG questionnaires, and maybe some are like lightly testing impact, and then trying to like support the portfolio company like during the portfolio management to help them become more sustainable. But what we are working on, I think, which is like on the roadmap for maybe next 1 or 2 years, as you said, is really to be able to quantify it better, set up reporting, set up KPIs that you track across the entire portfolio that you can then report back to your own LPs, is difficult because like there's no consensus on like which KPIs to track, and the companies themselves are not tracking them yet. But it's a progress.
Sounds good. So what's Alter Equity's kind of ambition in that sense?
I think first we have done the demonstration that works. So now we really want to spread and to develop on the European basis first. And then we also would like to show that there is a sustainable model also on not only on equity, but also on debt, also on real estate, also on larger equity operations. So yes, that's the objective in the next 3 years.
Cool. So now that we have learned quite a bit about the perspectives of the respective institutions you are covering, I would also be maybe for the last 2-3 minutes be interested, what's your personal view on the topic, and also how do you define actually sustainable thinking? So maybe starting with you, Melisa, when you hear that term, what comes into mind, and maybe also how do you deal with that topic on a personal level?
I would have to say I would like the institutions for which we work to abide by the principles, even political principles that we are made. We're all working now towards Paris 2030. It would be great if we could do it faster. Like, why wait for 2030, but next year? So I would say to make every decision a positive one now for the environment and for the community.
Good. Lisa, what's your view?
I think I had a slightly different interpretation of your question, but like, how would I define sustainable thinking? I was interpreting it more as like on a personal level. I think it's important, like to yes, no, like what can we achieve in the jobs, like the profession that we're doing with like the organizations that we have. But I think it's also important to really on the individual level to adapt your own behavior, even if, okay, on the grand scale of things, it really doesn't matter if I'm vegan now or not. But it helps me, like I became vegan a few months ago, and it's so difficult to like go around and like find things to eat. But it creates awareness inside me, like that we still need to change a lot. And that the comfortable way of living, like the mindless way of living, we cannot keep on doing it. So I think it's really important that we all like change our own behaviors to the extent that we can, of course, without like going crazy, because that's not good for the mental health either, which is not sustainable again. But it's really important, like also on the personal, individual level, to change.
Then Félix.
I'm very aligned with what Lisa said, and there is solution to change your habits, the way you consume, as Ines showed for the bank provider. So, and there is solution in a lot of sectors. So, just start thinking on my impact and how can I lower it.
So I guess that sums up the panel discussions quite a bit. So positivity, awareness, and maybe start with yourself. And I think overall, I think we have heard quite some interesting facts, and at least from my perspective, also very promising future, in particular for the startups. I think in the auditorium, dealing with these kind of day-to-day challenges. That at least from an investment perspective, it seems you're on the right track and there's plenty of money to be implemented or allocated in that space. Just need to find the right partners, and then we can hopefully all work towards a more sustainable and brighter future. And with that, I would like to conclude this panel. I'd like to thank very much Lisa, Melisa, and Félix for your contributions, and everyone here in the room for your attention. Thank you very much.
Are you all still awake, or are you already dreaming? Because we have still some interesting topics coming up. And I want you to pay attention to the next one, because it's all about collaboration and the question how we can drive innovation through cooperation. And I welcome on stage Mr. Georg Schürmann. He is the managing director of Triodos Bank. And with your bank, you're committed to use money as a catalyst for ecological and also cultural change. And I'm very interested in your thoughts how we can actually use cooperation as a tool.
Yep.
Thank you.
So, thank you. Good afternoon, and thanks for the invitation, and also thanks for the nice introduction. Yeah, now it's coming really concrete. I would like to explain a little bit how an impact bank is working. So it starts with the banker and it ends with the banker this afternoon, and I will explain a little bit about banking. But it's very important for me also to explain Triodos Bank is not the only sustainable bank in the German market. There are also our colleagues from GLS Bank, from Umweltbank, and I'm also happy that the new kids are on the block, like Ines with tomorrow, because we as Triodos Bank are too small to do it by ourselves. So we need others to join and to rock the market and to do the next steps. So it's a very short agenda for this afternoon, the last session, just before the final of this day. I would like to start with the why. What is the intention of the organization, but also what's the intention of myself? And it's relatively easy. With a bank, it's about people. Our financial and banking services are for savers, investors, and organizations who want to change the world for the better. It's about change. Our customers are already playing their part in a positive movement. We, as a bank, connect people. We serve people. We are in the service industry. We are part of a sustainable community, but we are only part of it. We also promote the conscious use of money. It is different where to invest, and this was mentioned already this afternoon. This was mentioned by Ines, and what to support. ESG has to be part of every investment decision, like Andreas explained this afternoon. Besides risk and return and liquidity, ESG is one of the criteria of decision. And as you can see, innovation is part of our philosophy. We have to innovate as a bank. I would also like to explain a little bit my personal motivation, because that's important. Why are we doing banking in a different way? So I am a banker, as I mentioned, and I've only learned banking, so I only can do banking. I joined Triodos to do banking in a different way, to live my personal life also in my business life. As father of 3 children, I care for the future. I feel responsible not only for today, but also for tomorrow. I am challenged by my next generation, so I have every day Fridays for Future. And this is really needed, to wake up. My personal inspiration is coming from a sustainability definition of the so-called Brundtland Commission, and we heard a lot about definitions of sustainability this afternoon. Sustainable development is the development that meets the needs of the present without compromising the ability of future generations to meet our own needs. So it's about the future, it's about fairness for the next generations, to care of the planet. The planet is our home. But now let's start to talk about the what. What is an impact bank doing? We have high ambitions. Core business is financing change. It's about financing the transition, and that's important. Transformation is needed for a sustainable world. Just planting trees is good, but not good enough. Transition is needed. Everyone is aware of the energy transition, but there's more to do. Transition is needed in almost all sectors of the economy. We bring together sustainable investors and savers with sustainable enterprises. Together, we generate impact. We as Triodos Bank want to be an example, a role model. That's all. So we invited people to copy us. And this is about change finance. This is a very high ambition for a relatively small bank, and I will give an example a little bit later. Back to finance change. These are the sectors we are in. We finance and invest via the investment funds of Triodos Investment Management into different sectors. We in Triodos Germany focus especially on energy and infrastructure, financing the so-called German energy transition, Energiewende. Everyone is aware of this. And financing Energiewende does not mean only financing windmills or PV panels. It's a little bit more. So we started to look into what's needed for the transition and what's really new, so what's innovation. So for example, we financed battery storage. That's new, and we have done it in a club deal, so not alone, again, together with some other banks and an entrepreneur to stabilize the grids. So, and this is important because therefore a power plant with coal could be shut down. So it's really important also to think a little bit broader. This is one aspect. Another aspect we are doing is financing infrastructure, so-called social infrastructure. We are financing glass fiber infrastructure in rural areas to connect people also to the digital world. Another part not on this slide is social. So for example, we are financing elderly care homes, very concrete, and now we are entering also the sector of arts and culture in the German market, financing films. And this is an example where it's a little bit tricky. And there was a question this afternoon, what's sustainable? And when you start financing films, you say, okay, what's about this regarding sustainability? And this maybe is a little bit different compared to pure sustainability and a bank who's focused only on people, because we are interested also in people development, and therefore the culture is an important part. And we start now to finance the film industry, because that's a very small market, and a sustainable bank is needed in this market. But we don't want to finance any film. So it's really depending on what's going on. So we will not finance, we have started to finance a nice educational film for kids. That was the first project, and we are looking into this industry, but we will not finance every film and every contract we will ask for. But we are a little bit more exclusive and selective in this. The last sector I would like to mention is sustainable real estate, for example. This is also a sector we are financing, and we are focused again on people. It's not needed to have a certificate, a sustainable certificate like a LEED certificate or something. We are much more interested in what's going on in this building. What's the intention of the entrepreneur? Who is renting the building? These are the questions we are looking at. And also another aspect is the life cycle of the building. So it's much more than the CO2 footprint. If you look from a sustainable aspect into real estate, it's very much about life cycle. So we prefer to finance historical buildings or older buildings, and to finance the reuse of also such buildings. It's much more important than just look into CO2 emissions and the footprint of the building. Last but not least, I would like to mention the activities of Triodos Investment Management. My colleagues are active in the emerging markets for more than 25 years. And a pioneer in microfinance. This is meant with emerging markets. One other segment Triodos Investment Management is active in is socially responsible investment. One of the debates we have today is how to generate positive impact with such investments. We as Triodos Bank believe that active stewardship starts with proper impact investment decisions. A vital part of our stewardship approach is investing in companies that support the transition to a sustainable society. We actively engage in dialogue and feedback loops with companies to positively influence their business. We also regularly collaborate with other institutional investors and industry bodies to further steer sustainability-related best practice. So it's about influencing companies. It's our policy to vote at the shareholder meetings of all companies in which we are invested. So we are an active investor. We believe that by exercising our voting rights, we can exert a positive influence on a company's long-term strategy. This is generating impact also with listed companies if you are using your influence, if you start talking to this kind of company. So this was just a small introduction in what we are doing. And then now I would like to go to the how. And it's about innovation. It's about innovation together. As a frontrunner in sustainable finance and Europe's leading sustainable bank, innovation is key. We have seen new companies are entering, startups are entering the scene. This is good. This is really invited. And I would like to see more than only Ines with tomorrow entering the field and really bringing new dynamic. But this is also pushing us a little bit into the next phase and thinking about what's needed in the next phase. But we are an expert in impact. We are an expert in impact banking, impact investing. We are not an expert, for example, in digitalization. So we cannot do innovation on our own. And we love to do things together as partners, together with clients, together with other banks, together with fintechs, or together with specialized companies. And I am happy to give some examples of innovation. This is an innovation 3 years ago. We have launched the first credit card based on renewable raw materials saving CO2 emissions. And this is also giving just an example. We have done this innovation together with our partner for payment products, it's DZ Bank. Unfortunately, not Commerzbank, it's DZ Bank. We just wanted to show that plastic is not needed to produce bank or credit cards. Some banks followed, and also Ines with Tomorrow followed with their card, which is not based on CO2 emissions, which is not based on plastics. And we are very happy when we are imitated. So this is an example where we teamed up with a partner, DZ Bank, to start innovation. So another one is the climate commitment of the German financial sector. And this afternoon, Matthias mentioned it because we have done it together with WWF. We initiated the German climate commitment. Many financial institutions signed the commitment to align their loan book with the Paris Climate Agreement. All signatories will publish targets for alignment latest end of 2022. This is contributing to the German financial sector to Paris. A lot of Frankfurt-based banks, like Commerzbank, joined the commitment. Again, we cannot do it alone. We have to team up, and we are happy that we are able to team up. And the last example is the newest baby. It's a so-called Digital Triodos Impact Portfolio. And this is only a prototype. We are doing this together with Investify, and Investify is also present here at the Impact Festival. Because we are not a specialist in digitalization, we are specialists in impact banking and investing. To build a state-of-the-art digital impact managed account, we teamed up with Investify. Investify is also here, as I mentioned. Triodos Impact Portfolio will be the first managed account in the German market based only on so-called SFDR Article 9 compliant investment funds. What does this mean? All investment funds have to be transparent about their ESG strategy since March 2021. This is a new European regulation, also mentioned this afternoon. To simplify, funds have to declare if they follow ESG. If it's simple ESG, it's just Article 8, or if it's impact, then it's Article 9. But only very few funds are compliant with Article 9. It's less than 3% in the market. Therefore, the new Triodos Impact Portfolio is unique because it's only with Triodos or with impact funds. And this is definitely new for the market. Another element that will be new in this product is that we are including microfinance. As you have seen, we are one of the experts in microfinance and have a track record on this. And this is real innovation because, and I was surprised when we started the project, that this will be the first impact portfolio, or let's say managed account, or you can also call it robo-advice, with microfinance in it. And that's our role, just to bring small innovations into the market, to show what's possible in the market, to show what's about real impact. But it was not so easy to realize. It takes a little bit longer than we expected, and we will launch in a few days. But we are happy to present this impact portfolio also with the state-of-the-art impact reporting. And impact reporting, impact measurement is also important, like Andreas told this afternoon. But also that was something we have learned. Very few funds have a state-of-the-art impact reporting. And also from a technology point of view, it was really a challenge to integrate this impact reporting into this. As you can see, we can't do it on our own. We have to team up, and we like to team up. We like to team up with other experts. And this is just an example out of 3. We, Triodos Bank Germany, can do this never alone. We like to do it with partners. We are happy to team up, and we are successful only as team players. So thank you very much, and enjoy the festival, enjoy the evening, and I'm running out of time, so goodbye. Thank you very much.
Thank you very much, Georg Schürmann, for the final keynote of the day. We've come a long way. This was day 1 of the Impact Festival. I would say for most of us, this was the first real live festival in a long, long time. Has been a great journey for both of us today.
Lots of input.
Lots of input for sure. We're going to continue tomorrow, so you will see us back on the big stage tomorrow at 9:30. I'm going to get some pizza. We're going to get some pizza now. But the program here is not finished yet. There's a quick break. At 7 o'clock will be the Impact Awards ceremony here on stage.